I'm here with Paul Hamill, who runs the fixed income, currencies, and commodities business for Citadel Securities. Paul, good to see you again.
And you, Erik, welcome to Citadel.
Thank you very much. Here's where I'd like to begin, with MiFID II, because as you know, and so many people know, it's roiling the financial industry. How do you see it playing out from where you sit?
Well, it is a very large change. I think the way it's important to remember, this stems from the commitments that the G20 made in 2009 to fundamentally reform financial markets, especially swaps, and make them more transparent, and more robust and resilient. MiFID II is effectively Europe's Dodd-Frank, if you think about it in that term of scale. So it's very, very large and impactful, and naturally everyone's focused on the impacts.
How is it going to affect your business?
Well, our business, we're in the business of making markets to clients and investors, and of course
providing liquidity.
Providing liquidity. We've been active in Europe for several years now, preparing for the growth of swaps. We built our euro and dollar swaps business in 2015. It'll impact us because it will bring more trading to electronic venues. It'll bring more robustness to the market in the form of clearing. And clearing is a fundamental pillar which allows customers to access new sources of liquidity, moving away from the old bilateral documentation structure, where risk goes to the clearinghouse. Then they can focus on who's got the best price, where can I see the best execution for me and my investors.
It sounds to me like you think, or at least expect, that it's going to be good for your business. How good?
I think it'll be good for everyone, and the way our business model is set up, what tends to be good for the market is good for us. If you build your business around one where you want markets to be fair, level, more transparent, and we can thrive in that competitive situation, then we expect it to be good for us. Investors that are going to benefit most from MiFID II, and that's something we've seen in the US with Dodd-Frank, they benefit most because when you have greater transparency, both pre and post trade, it leads to a better execution, and we've seen that quantitatively it leads to better prices, tighter prices for investors, and that's something we've been very good at playing our part in.
I like the idea that it's good for everybody. The reality is that it's not good for everybody. Good for the investors, for sure. Not always good for the service providers, the vendors, if you will. Who's most vulnerable?
I don't know who's most vulnerable here. I actually think that if you're well positioned and the preparation is done, the most important thing about major regulatory reform is to prepare and be ready. A failure to plan and a failure to prepare is what leads to problems. So we're certainly ready. I think some of the big trading venues we see are ready. I think our clients are at different stages of readiness, and that's going to play out over the course of next year.
Talk to me a bit about that. I'd like to know what you're hearing from clients. Do they understand what these rules are? Do they understand the timeline on which they're going to be rolled out and how they're going to be affected?
I don't think there's the level of understanding that people would like to have. And I think that stems from the challenge that we face, that some of the rules are still not clear. We got 2 months to go. But when you and I last spoke, there was a lot of rules that were still not clear, and we've seen enormous progress this summer, in particular areas of things like the trading mandate and the requirement to provide impartial access. But there's a couple of critical areas that everyone is watching closely because they've got to be resolved before year end.
And those are?
Well, the first one, and this is almost ironic, transparency is a core pillar of MiFID II. And yet we've seen, almost by accident, some sort of flawed calculation method under the European rules, which would term most swaps illiquid and therefore not subject to any kind of transparency and reporting regime. And that's the complete opposite of what we've seen in the US. And so I think ESMA are aware that that's a challenge. We're working closely with them to try to resolve it. But it's critical it gets resolved because investors are paying for MiFID. One of the biggest complaints is the cost that these implementations bring. If you get all the cost of transparency without the benefits, and it's going to be a long time, we think, before that gets fixed, I think that could be a very bad outcome for investors.
Even if the MiFID regulators succeed in sorting out these lingering issues by January the 1st, it's still not going to be perfect. What in the European market will still need work?
I think preparation, I think even if, we're 2 months out, so if we change at this point, which we still think would be the right thing to do, the transparency requirements, and change the venue requirements are unclear. It's still not even clear who needs to trade which products on which platforms. If that gets resolved with 2 months to go, it's unrealistic to expect everyone's going to be ready on January the 3rd to fall in line there. So I do think we'll see some bedding in over the first 3 months of next year as people react to the final details that are going to come out over the next couple of months.
And what if these transparency and venue issues either don't get sorted out or don't get sorted out the way you'd like to see them sorted out?
Well, the transition from trading bilaterally onto venues and the transition from having some reporting and some public information about the transparency in the market and the price where things are getting executed are two of the biggest potential benefits to investors. They're also two of the biggest costs because they're the two of the most new and transformational things. If they don't get sorted out the way that I think the market would expect them to, we expect it could take up to 12 to 18 months, if not longer, to see the kind of changes implemented to fix them. So we'll see, frankly, a lot more of that kind of, I think, negative sentiment around the regulation itself if people are required to pay for it without seeing any real change in process or
they'll be that much quicker to embrace it, in other words, if it's fixed.
Yeah, and that's what we've seen in the U.S. And, interestingly, we've seen a lot of reports, including the recent Treasury report, that just highlighted the widespread support there is in the market now for these reforms. But in the U.S., they worked hard, and it was a big transformation in the market, but they all kind of came together at roughly the same time, and we learned that really matters.
You're referring to the white paper that came out earlier this month from Treasury.
That's right.
How do you expect Citadel to fare under the changes that Treasury proposed?
Well, I think like most market participants, we expect to fare, well, because what was potentially, discussed at one point was a big rollback of regulations and this reintroduction of a lot of certainty and moving backwards in terms of robustness and stability. And what we've actually seen is, is a very, very thoughtful report that outlines the desire to lock in the gains with some small but very important changes to make the market even stronger and safer. And so we're very pleased, I think, as most market participants are, to see, for example, an appetite to change rules that make clearing more accessible to more participants. That's been something that a lot of people have been concerned about, the capital implications of providing clearing services when the whole world is moving towards clearing their products, and that looks like it's going to get resolved. So we're very pleased about it, and we'll continue to grow, and the certainty it creates allows us to keep investing in our business.
How important is regulatory change as a factor in deciding where you invest and how aggressively you do it?
I think having a certain path as to what's going to happen in the products that we transact in is desirable
for everybody.
I think. But if you look at our European business, we invested several years ago. We're confident that it's the commercial value of the proposition we have as one of the top market makers in the world in equity and rates products. We price swaps differently. We price treasuries differently. Our model is innovative. It delivers a different experience to clients. What some of the reforms do, like MiFID II and Dodd-Frank, is they make it easier for us to get our product to the clients. They make the distribution component of it a little bit easier. So if stuff is trading on a venue versus over the phone, then we have a better shot at showing how much better our price is and the quality of the liquidity that we have. But it certainly doesn't mean we need those changes. They act as a tailwind to our business.
Paul, I want to ask you about ETFs. The focus on ETFs and fixed income has mostly been on credit.
Yeah.
High yield and investment grade, but more and more people are beginning to talk about the impact that ETFs are having on the treasury market. What are you seeing?
Well, we're certainly seeing an increase in volumes in our business related to those to ETF market making from some of our clients who are very involved in that. And I think generally it reflects the trend in growth trend we've seen in a move towards passive investing. So I think, and that's linked to the low volatility environment that we're in. So I think if we continue down this path, you would expect it to continue to grow. Of course, there's a whole different conversation around what volatility might look like in 2018 and what impact that might have on passive investing overall.
Is that a business you feel you need to build here? More ETF capability?
Well, certainly, our ETF business is one of our potentially growing areas of investment, and I think
you're huge in it on the equity side.
Sure, we are. Equities and options.
Income.
We're largest in the U.S. in both of those markets. I think my colleague Joe McCain is going to talk to you later, and I'm sure he'll be thrilled to talk to you about ETFs. But certainly, active liquid benchmark markets and products where investors are looking for liquidity is surely somewhere we're going to invest.
And you've been building a swaps business.
Sure.
Aggressively, migrating out of the sort of vanilla products that you started with.
Yep.
Where do you stand? And I also want to know, what's next?
Sure. So where we stand, we have some very good recent news. We were thrilled to hire Dan Gotlander to come in and lead our swaps business. He came over from Citi, joined us just a few weeks ago. So we're still formulating the velocity and scale of how we're going to go out and engage our clients. A big part of this, the build work we've been doing through the course of the year. And let me just clarify what that build work is. To move beyond the liquid benchmark products into the whole other universe of swaps, which are a little more complex, more nuanced, more package-driven. And that's about 60% of the market. It takes a lot of risk management work and other stuff. And we've been doing that in anticipation of Dan arriving and helping us build that business out over the course of the next 18 months. Like our treasury business, a lot of it is predicated on expanding the client base now that we have a more intense and valuable offering. And that's something we're very focused on, in particular in Europe and Asia next year.
All right. Paul, great seeing you.
Thanks, Erik.
Thanks for having us to the Citadel Securities Trading Forum.
Pleasure.